If you're paying taxes, which let's face it, most of us are, then you need to hear this because I can almost guarantee that a lot of your hard-earned money is slipping away without you even realizing it. Think I'm exaggerating? Check this out. In the US, the average single worker hands over a whopping 30.5% of their income to our friends over at the good old IRS. Think of it kind of like this. The average person is working a third of the year, a third of the year just to pay the tax man. And you know what? That's just not right. But here's the deal though. There are several legal ways to actually shrink that tax bill that hardly anybody talks about. And don't expect the IRS to come around telling you about it because the less you know, the more they can collect. So it's time today that we discuss a few things. The first, how the tax system works. Next, the best ways to legally save big on your taxes. And then we're going to highlight some of the most overlooked tax strategies that you can start using today. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist that's simply out here on a mission to get you out of the rat race with financial freedom. And it all starts with how money works and how taxes works. Oh, and also I want you to keep something else in mind. This is not financial or tax advice. I'm just a random guy on YouTube. Don't rely on me. Go and consult with a professional. So if you understand that, let's get going. All right. So here's the trick. And they didn't teach me this in college or dental school, and probably you didn't get this either. The trick is about taxes. You want to lower your taxes and you want it to make it look like you're earning less on paper without actually reducing your income. Sound good? Okay. Now, the first strategy, more than likely that you've heard of this before, very common, 401k. Of course, is a retirement account that helps reduce your overall tax bill by this year letting you chip in $23,000 a year from your pre-tax income. So every dollar that you add to your 401k is one less dollar counted as your taxable income. All right. So it's kind of like a little magic trick. Less income showing on your paper means that you have less tax to pay. Is what we just discussed. And this basically now leaves you with more money to invest. So if this is a little confusing, let me break this down. So imagine that you're making six figures. You're making $100,000 a year. And then you decide that you want to invest $15,000 to your 401k. All right. So now for tax purposes, this is because we want to reduce your taxable income. For tax purposes, you want to take 100 minus 15,000. This is with if you're paying taxes on $85,000. All right. So let's say that you're in the 24% tax bracket. Then if you utilize this strategy, you're going to have a tax savings around roughly, if you're in the 24% tax bracket, roughly around $3,600 a year. All right. Also, some employers are even going to match your 401k contributions dollar for dollar up to a certain amount, essentially doubling your investment risk-free. But there is a catch. Remember, what goes up must come down. And the downside is that you'll have to pay taxes on the money when you withdraw it from your account, usually starting at the age of 59 and a half. But here's something else to keep in mind. Tax rates actually might be higher down the road than they are now. From my point of view, a 401k only makes sense really in two situations. First, if your employer is going to offer that match, okay, go for it because again, it's like doubling your money without any risk. You're going to get the money regardless. And number two, if you're currently now already in a high tax bracket, but you expect to be in a lower one when you retire, you could end up saving a decent chunk of change on your taxes. All right. So that's number one, the 401k. Number two, this actually brings me to an option that I think is even better than a 401k and even less people talk about, and that is the HSA or health savings account. Now, this account is designed to basically cover your out-of-pocket health expenses. But here's the kicker. You can invest the money. It has what's called a triple tax savings. So you can invest the money in an HSA, basically giving your tax savings an extra boost. And here's basically why I would consider this one of the best tax advantages accounts to ever exist. Okay, here's the triple tax benefit that you'll get. First, any money that you put into this HSA up to 4,100, 4,150, something like that in 2024. So you can put up to $4,150 not taxed. So it's going in and it's not going to be taxed. Second, when you use this money for health-related expenses, when you actually take money out and pay for things, health-related expenses, because at some point we're all going to have health related expenses, right? You're not taxed on this money when you take it out and pay. Okay, so it's like getting a stream of completely tax free money to invest, and then you're never going to be taxed on it when you spend it on qualified expenses. And if you're in a 22% tax bracket, that's actually a net savings of $1,000 immediately for maybe like 10 minutes worth of setting it up. However, keep in mind that in order to qualify, you must have what's called a high deductible health insurance plan. All right. You have to have a high deductible health insurance plan, which means in 2024, you have to have a deductible of at least $1,600 for individuals and $3,200 for families, along with some you may have a little bit of fine print to read depending on what state you live in. But that's generally the consensus how that thing works. So, but assuming you actually fit the criteria, HSA is one of the best ways to save money on your taxes, hands down, for the least amount of work. Which leads us to number 3, the long-term capital gains tax. All right, and this is a very popular, especially in the U.S., is a very popular tax break when you know how to leverage the long-term capital gains tax rate. So here's how it works. If you buy an investment and you sell it within a year for profit, that profit is actually taxed as earned income, which depending on what tax bracket you're in, if you're in the highest one, if you're in a 37% tax bracket, you're going to be taxed 37% plus any state income taxes. That's pretty darn steep, okay? But if you hold on to that investment for more than a year, just 366 days, and then you sell it for a profit, it actually falls under the long-term capital gains rate, which for most of us is much lower. So for example, the federal long-term capital gains tax rate, it's only the highest rate is only 15% for people earning between 47,000. So if you make between $47,000 a year to $518,000 a year, the long-term capital gains tax rate is only 15%. That's a whole lot better than 37% federal. Okay. So literally anybody making over $50,000 a year, this is a substantial savings. And it gets even better for married couples filing jointly with less than 94%, $94,000 in income. Okay. If you're married filing jointly and you make less than $94,000 a year, okay, your long-term capital gains tax is not 15%, it's actually 0%. 0%. You do not owe a single cent if you sell something for a profit and you hold it for over a year. That's pretty darn good. All right. All right. Number 4 is for those of you that are self-employed, have businesses, you're basically going to take income, you're going to run income through an S corp. All right. Or run it through an S corp or an LLC. All right. So again, for those of you like myself that are self-employed and you're always looking for a way to reduce your tax bill, one of the top strategies is actually setting up an S corporation or an LLC taxed as an S corporation. Again, that's why I said make sure that you use your accountant or attorney or both in these things. But they'll be the ones that can basically walk you through all this, set this up. I'm just going to kind of give you the high level view. Okay. So by doing this is basically when you set this up, this is a legal entity that you can create to basically just run your business through. So here's how it works. Your self-employed income flows into the S corp. Okay, your self-employed income. Let's say you make $200,000 a year of self-employed income. That would flow into the S corporation. Then you deduct any business expenses, and what's left over is your profit. So if you have $200,000 of income and then you have $100,000 of expenses, what's left over, that $100,000 is your profit. Okay. So to make this a little bit simpler for you, think of the S corporation. So if you're self-employed like me, think of the S corporation as your employer. Okay. And you're the employee and you want to pay yourself a reasonable salary from the S corporation. And any remaining profit is just going to be distributed to you later in the form of distributions. Now you may be asking yourself, well, why? What's the big deal about this? Why is this so good? Because these distributions that you get from an S corporation aren't hit with any FICA taxes, Medicare, Social Security taxes. That could mean a savings of up to 15.3% on your money, and that can add up over time really quick. All right. So let me break this down for you. All right. So I want you to, you're self-employed. I want you to imagine that your business brings in $120,000 a year in profit. Okay. $120,000 a year in profit. All right. So let's say you decide to pay yourself, we'll put on here $60,000 salary. So half of that. All right. So by running through an S corporation and by taking the remaining, so now you're going to have the remaining 60,000 as a distribution, right? You could save roughly, just by doing that, and I've already done the calculations ahead of time, so we don't have to get a calculator out. You're basically going to save, just by setting this up like that, $9,000 a year in taxes. Think about that over the long run. $9,000 a year just from setting up this structure. And again, now it's important that I want to point out to you, this isn't some one size fit all solution. There's specific rules and requirements for setting up and operating an S corporation, and it's definitely worth you sitting down with a CPA. Your CPA, if you don't have one, I'll put the link below this video of mine to get the details right. Now, while I'm here to basically give you a heads up on the strategy, again, you shouldn't rely on some dude from YouTube for tax advice. Check with your CPA. All right. So now to my favorite strategy, and we're also going to break this down into multiple segments of this strategy, as you could probably guess, from real estate. Okay, from real estate, and basically some of the different homeowner tax benefits that you can get out of this, but commercial real estate too. And I'll break this down for you. Okay. All right. So more than likely you're a homeowner. Okay. So if you're a homeowner, then there's some really serious tax breaks that you could be missing out on. Okay. Here's a quick rundown of what's available. First off, capital gains exclusion. Okay. So this will actually let you sell your primary residence and not pay taxes on the first $250,000 of profit if you're single, or $500,000 of profit if you're married. What's the catch? Well, the catch is, again, you have to have lived in the property for at least 2 of the past 5 years. So to put this in perspective, let's say you bought a house back in 2018. Okay, you bought a house for 500 grand. All right, and now today, 2024, it's worth $1 million. It's doubled in value. Okay. Typically, if you made a $500,000 long-term capital gain, you owe, 15% or so, 15, 20%, whatever on tax. So roughly $100,000 in taxes. But with the capital gains exclusion, you're basically off the hook for the tax bill in this situation. Nothing. Again, keep in mind that's federal. This doesn't cover state taxes, which still dodging a 20% federal tax hit. That's definitely something that you want to consider. So let's do a couple little subcategories under real estate. This one you've probably heard before, and it's one of my favorite strategies. This is the 1031 exchange. Okay, 1031 exchange. This is a great tool, fantastic tool if you own rental property. So here's the thing. If you have a rental property, when you sell it, you can put off paying taxes on that sale indefinitely. Well, you're probably saying, well, Jeff, what's the catch? Well, the catch is you have to reinvest in another property within a specific time frame. So here's an example. Let's say you purchase a rental property for $200,000, and now it's doubled in value. Now it's worth $400,000. Normally, if you decided to sell, you'd be paying taxes on that profit, or $200,000 in profit. But here's the magic of the 1031 exchange. You can actually sell that property for the $400,000 and then roll that money into an even bigger deal, effectively trading up without any immediate tax hit. But keep in mind, this does not apply to your primary residence. But for rental properties, it's a game changer. It's a great way to keep growing your investment portfolio while deferring your taxes. And speaking of taxes and portfolio, one of my favorite topics in real estate is something called depreciation, not appreciation. I like real estate because it appreciates too, but depreciation. So this is how some people can rake in thousands, even tens, sometimes hundreds of thousands of dollars a month in profit, but on paper show a loss. And they owe zero, they owe nada in taxes because of depreciation. All right, so here's the simple version. The IRS figures that your property structure, okay, let's say you buy a house and you're renting out, you're doing like a long-term renter, okay, you got a renter in there, okay. The IRS figures that that house, the structure has a lifespan of 27 and a half years. All right, 27 and a half years, because over time things wear out, right? Things need to be replaced. The roof, the windows, the doors, the floors, the painting. It's not going to last forever. Okay, so the IRS comes up with 27.5 years. Now, this is when this is where depreciation comes in. Okay, so if your property structure, let's say, just to make this math easy, if your property structure is valued at $275,000, you divide it by 27 and a half years, and voila, you've got $10,000 per year in depreciation over the next 27.5 years. That you can take this depreciation that you can use to offset against any profits that you're going to make on said rental house. It's a great way to keep more of your money in your pocket, okay? And to really up your game, if you don't want to wait around, who wants to wait around 27 and a half years? If you really want to accelerate your depreciation, then on that rental property, you can get what's called a cost seg or cost segregation analysis. Okay. Now, this will, a group comes in and they'll basically allow you, they'll segregate out the property that lets you accelerate the depreciation on different items. Okay. It allows you to write off more expenses upfront and faster. Okay, I've got a couple of videos on that. You can search for cost segregation analysis. Now, once you basically maxed out all of your depreciation benefits, you can do a 1031 exchange into a new property. Guess what? You start all over again, potentially deferring, depending on where you are in your process, you could potentially defer hundreds of thousands, maybe even millions of dollars in taxes. Okay. But a word of caution, this strategy is very complex, so it's best to leave it up to the pros. If you want to know who we work with to get a cost segregation analysis on our RV parks and mobile home parks, I'll put the link below in the description in the video. And last but not least, the good old, still under real estate, the cash out refinance. Cash out refinance, okay? Refinancing, basically, you've probably heard of that before, okay? So if you're not looking to sell, so let's say you buy a property. So like right now, the interest rates are high. Okay. So you buy a property. Okay. But you're not looking to sell, but you want some access to your equity that you have in the property, then this cash out refinancing could be an option for you. Okay. Again, currently high mortgage rates, depending on where you are in the country, 7, 8%, even higher. It might not be the most appealing choice now, but it's worth considering once those rates start to drop. So here's the best part. In the eyes of the IRS, loans taking out against assets that are not counted as income because you haven't actually sold anything, right? You still have your property. You're just refinancing out. You're getting a new loan. Guess what? When you do this, you don't owe any taxes on this income. So it's a clever way to tap into your property's value without actually triggering a tax event. So for instance, imagine you bought a property for $100,000 and now it's worth $200,000. So if you choose to sell, you'd be looking at taxes on that $100,000 profit, which could be around 15 to 20%. However, you can sidestep those taxes by opting for a refinance. So this way, you can actually borrow against that equity that you've built up in that house. So from $100,000 to $200,000. Okay, and since you haven't sold the property, you're not going to owe anything to the IRS. It's a really smart move to access your property's increased value without incurring a tax hit. Finally, I've saved the best for last. Okay, and this strategy is like the golden gem, like the golden goose. Okay, and it's actually called REP status, real estate professional tax status. So this is like this is what, if you can, depending on your situation, if you can do this, this is the game changer. Okay, what is it? It's a special tax break that's not really widely known, but it can be incredibly powerful. Okay. So usually if you're earning a W-2 income, let's say that you're a position working hospital, whatever, your options for tax write-offs, let's face it, are pretty limited. Okay, so let's say you're like a orthopedic surgeon, you're working like in a hospital or a group or something. More than likely, you're probably paying 40+% taxes when it comes to federal and state taxes. But things can change if you or your spouse can qualify for real estate professional status. So here's where it gets interesting. So you can actually use all of your real estate paper losses. Remember, we talked about depreciation and accelerated depreciation and cost segregation study. You can take those paper losses, the depreciation, to now offset your W-2 income. Suddenly, you could potentially find yourself owing zero, nada, to the IRS. So imagine that you're earning, let's say, $200,000 from a W-2 job, and you're working full time, and you have your spouse who's only working maybe part time. Maybe they don't even work at all, and they're the ones that qualify as a real estate professional. And let's say that you've gotten $200,000 racked up in real estate losses through cost segregation this year. So these paper losses can completely cancel your W-2 income, reducing your tax liability to zero. Now, of course, claiming real estate professional status isn't something to take lightly. You need to prove it to the IRS if you're audited. And this involves basically you have to dedicate more time to your real estate trade or business than any other business activity, and spending at least 750 hours a year on the real estate, which equates to about 15 hours a week. But if you do meet this criteria, this strategy, again, can be a complete game changer for your tax situation. And finally, again, make sure that you get yourself a top-notch CPA. You want to surround yourself with experts that are way smarter than you, okay? And because the main goal of this video is basically just to spark some ideas that point you towards strategies worth exploring. But let's be real. And I don't know if you've ever seen the actual tax code book, but it's 4 or 5,000 pages thick, very complex. Every situation in it is unique with a lot of variables at play. So it's essential that you lean on your professional that you hire for any tax advice that you're considering. I personally invest a hefty sum every year to ensure that my taxes are handled correctly. I don't leave it up to TurboTax. I have a professional for my situation. If you want to know who I work with, I'll put the link below the video. Again, if you want to know who I work with for cost segregation analysis for our properties, I'll put the link below the video. Now, again, this whole situation, all these tax advices, this isn't something that you can just go through and you take each one of these things and you think you can DIY, do it yourself. My advice, again, bring a good CPA on board early in the year if possible, because they're the ones who are going to be able to tailor the best tax strategies for your business, helping you legally minimize as much tax as possible later on in the year. Now, if all this sounds good to you and you want to learn more about my favorite strategy, real estate, lowering your taxes, how to lower your taxes with real estate, if you want to do that, you can check out this next video.